Hello, everyone, and thank you for attending our discussion on Are Metals Ready for a Move? My name is Tom, and I'll be moderating tonight's presentation. And we are very fortunate this evening to have two very respected metals analysts leading the discussion. Brien Lundin, editor of thegoldnewsletter.com and CEO of the New Orleans Investment Conference, and Avi Gilburt, founder of ElliottWaveTrader.net. As you will soon find out, Brian and Avi take maybe even very different approaches in analyzing the metals market. Brian taking more of a fundamental approach, while Avi uses more solely technicals. And yet their analysis has started to converge to a point where they're essentially looking for the exact same thing in the metals market. So we look forward tonight to introducing you to both views and then also telling you where we see the metals market going in the future. Now, we've got a lot to cover, and we also want to make sure to leave time for Q&A at the end. So let's jump right into the first question. And Brian, I'm going to start with you in terms of the answer.
Good.
The question is this. Can you please describe what strategy you use in analyzing the gold market and arriving at your conclusions on where the gold market is heading?
Sure, it's actually not a really easy question to answer. I know Avi's probably going to have a much simpler, more concise answer for himself. But you know, I've been in this market for, I guess, 33 years, watching gold on a daily basis at this point, and it's really a combination of things. I do some very rudimentary technical analysis, nothing like Avi does, looking at a few indicators here and there. But a lot of it's the feel, knowing when the market kind of wants to go higher, knowing when it's not going up on good news, then we're in a bear market environment. I use seasonality a good bit. I use an understanding of monetary policy and monetary cycles to try and figure out where we are in those cycles. So it's really a combination of things that come together over a few decades of watching the market, you know, so closely, literally on a day-to-day basis, for better or worse.
And maybe just a quick follow-up on that as we start to get into some more of the analysis and what we're seeing in the markets. And what are some of the long-term fundamentals that you see? So first, kind of where do you see the gold market heading in the future? And then what are some of the fundamentals, long-term fundamentals that you see that are arguing for that position?
Well, I think for me, the fundamental driver that I see is the debt, the U.S. debt, the federal debt, and really the global sovereign debt for all of the developed economies. What I tell people in my presentations and articles these days is that what we're seeing here is nothing new. There's really nothing new under the sun. Throughout human history, throughout 4,000 to 5,000 years of human history, governments have overspent. They've either through wars or entitlements, they've overspent their means, run up debts, and resorted to inevitably and always debasing the currency so that those debts the values of those debts are greatly depreciated. It's happened in Roman times, ancient Greece, all throughout human history. The one thing that's different today, perhaps, than we've seen previously in human history is that we have a global economy now. Everything's interconnected, and every major developed economy has simultaneously run up debts that are at this point unmanageable. So yes, they can, and they will, and they'll have to depreciate their currencies to lessen the values of those debts. But they're not going to gain any kind of a trade advantage by doing that, because every major economy is doing the same thing. Every major currency is being depreciated or will be depreciated as well. So it's a race to the bottom of the hill. Sometimes one currency will lead the others, and other times it'll lag, but they're all headed down the hill. And in a situation like that, over the long term, what can these currencies depreciate? And the only thing left are real things, or most among them, among these real assets being gold, the traditional, the historic standard of wealth. So I look at gold and silver as being inevitably headed higher because of the tremendous debts that we have right now in the world that cannot be managed through cutting budgets, through cutting spending, through growth, or through tax hikes. The only thing left is to depreciate the currencies, and it absolutely has to happen.
Thank you very much for giving us that insight and kind of getting this discussion started. So Avi, I'm going to switch over to you now, but the same question, and that is, can you describe the strategy you use? What is that voodoo that you do to look at the gold market, and what conclusions are you arriving at with using what you look at?
Thanks, Tom. Well, first I want to thank Brian for joining us on this webinar this evening. It really is an honor to be on this panel with someone of his experience and caliber. But as far as analysis methodology, I primarily use Elliott Wave analysis coupled with standard technical analysis. And for those that are not familiar with Elliott Wave, let me give you a little bit of a background. Back in the 1930s, an accountant named Ralph Nelson Elliott identified patterns, kind of behavioral patterns is what he really identified within the stock market. And he understood they represented the larger collective behavioral patterns of society as a whole. And in 1940, Elliott publicly tied those movements of human behavior to the natural law represented within Fibonacci mathematics. Now, Elliott understood that financial markets really provide us with a representation of the overall mood or psychology of the masses. And he also understood that markets are fractal in nature, which means they are variably self-similar at different degrees of trend. Most specifically, Elliott theorized that public sentiment and mass psychology move 5 waves within a primary trend and then 3 waves within a counter trend. Once a 5-wave move in public sentiment completed, then it's basically time for the subconscious sentiment of the public to shift in the opposite direction, which is simply the natural cycle within the human psyche and not the operative effect of some form of news. The mass form of progression and regression that he identified is basically hardwired deep within the psyche of all living creatures. And today we know that pretty tangentially as the herding principle, and it gives the Elliott Wave perspective its ultimate power. Now, over the last 30 years, we've actually seen quite a few social experiments that have been conducted throughout the world, and it's provided significant scientific support to Elliott's theories that he presented almost a century ago. Just to give you one example, in 1988, a study was conducted, and it was entitled "What Moves Stock Prices?" And the people who did the study reviewed stock market price action after major economic or other type of news, including major political events. And they were trying to develop a model through that they could be able to predict market movements retrospectively. Yeah, you heard me right. Retrospectively. It means they were not even at the stage yet of developing a prospective prediction model. But interestingly, the study concluded, and I'm going to quote, that macroeconomic news bearing on fundamental values explains only about 1/5 of the movement in stock prices. Now, they actually noted, and I'm going to quote again, that many of the largest market movements in recent years have occurred on days when there were no major news events. They also concluded that, quote, there is surprisingly small effect from big news of political developments and international events. Now, at Elliott Wave Trader, we've taken Elliott's methodology and made it much more powerful and objective by developing a framework around it that we lovingly call Fibonacci pinball. And I mean, this has led us to be able to make some major market calls. For example, when we call the top in gold in 2011 within $6 of the high, or when we call for a major multi-year rally in the US dollar in 2011, in the face of all the QE being thrown at it, when we were in the 73 region, and we set a long-term target of 103.53. And this we missed by 19 cents, as the high struck in January of 2017 was actually 103.82. We called the bottom in gold in 2015 to the penny the night we struck that bottom in December of 2015. We've been calling for the major rally in the equity and even global markets in 2016. We stayed strongly bullish through the elections, and even now we're looking for over 3,000 before we expect a 20 to 30% market correction. So, I mean, as I said, we use Elliott Wave analysis to keep us on the correct side of the trend, no matter what the market thinks or believes.
Thank you so much, Avi, for sharing that with us. So we're now that we've kind of laid the groundwork here on what are these methodologies and in general, kind of what are we seeing, what are we looking for? I wanted to drill down a little bit deeper here and give those that are here a little bit more insight into what they should be looking for in the metals market. So I'll stick with you, Avi. We'll start with you on this one. Question number 2. So what levels are you specifically seeing in terms of upside for gold and metals, and in what time frame? And if I can ask a part B to that, it would also be, and how do we know that it started? How do we know that we really are on the cusp of going to that target?
Well, first of all, we've got the charts that I think we can put up. So if you want to start with the gold chart, actually no, the best thing would probably be to chart the HUI. We could start with the Huey. That's probably the better chart to start with at this point. Now, let me take a step back, and I want to highlight a call that Elliott made back in 1941. And in 1941, Elliott wrote, and I'm going to quote, 1941 should mark the final correction of the 13-year pattern of defeatism. This termination will also mark the beginning of a new supercycle wave 5, comparable in many respects with the long advance from 1857 to 1929. Supercycle 5 is not expected to culminate until about 2012. So let's put this call into perspective. Elliott in 1941, and remember, while World War II was raging around him, and everybody had just come off the Great Depression, Elliott was calling for a multi-decade rally, a 70-year rally in the S&P 500, rather the Dow is actually what he was referring to at the time. Now, that probably has to go down as one of the best calls of all time. And specifically, the reason I bring up that market call is because back in 2015, we were highlighting that the Huey was presenting pretty much the same structure that Elliott saw back in 1941. So the Huey, as we were moving into the 100 region target we had on the Huey, which we basically hit almost to the penny, and oddly enough, the low on the Dow was also around 100 at the time. And that'll give you a little bit of an idea of why our targets are where they are. But with the same structure that the Huey presents now is what Elliott saw back in 1941. So to borrow upon Elliott's analysis, we're actually looking for the bottom of a corrective pullback over the next month or two. And that bottoming pullback, once we begin the next phase of this bull trend, we're looking for a 50-plus year bull market, similar to what Elliott saw back in 1941. And if you look at the chart on the Huey, I mean, you can see conservatively, and I know this may sound crazy from a quote-unquote conservative perspective, but conservatively, we're looking at 12,000 on the Huey, where now we're just below 200. We're looking conservatively at over 11,000 over the next 50 years. But ultimately, because these metals move in much greater strength than standard extensions, I'm just giving you the lowest end of our standard extension. I don't want to tell you what true extensions in metals and where this can take it, because you probably wouldn't believe me. But at the same time, look where we are today in the Dow with a starting point of 100 back in 1941. That'll give you some estimation of how I see the next major bull market in the Huey, in the Gold Bugs Index to really take us.
And maybe just kind of a second part B to that would be, so right here we're looking obviously at a monthly chart, because we're talking about a trend that's going to be going for, your projections are for a very long time. You said 50 plus years. In terms of now drilling down and actually figuring out this is great for a trend, can we start to look at weekly charts, daily charts, even potentially longer term intraday charts like the 1 hour, to start to look for are we beginning this move, and what are we looking for?
Well, at this point in time, I still think we are feeling for a bottoming in the complex. I still think it could take as much as another month or two until this bottom is struck. So that wouldn't surprise me if this still takes a little more time. But ultimately, what I'm looking for is a sizable five-wave structure off a low that we could strike anywhere over the next month or two. And then I'm looking for a corrective pullback. Once we get that corrective pullback and then we rally over the top of that initial five-wave structure, that is my signal that the next bull phase has begun.
So for people that are listening that are maybe not familiar with Elliott Wave, it's not necessarily a specific, at this point, price level that you would point to, but it's also in terms of how the structure, how we get there, how we consolidate after there, and then retaking out that high from that five-wave move that you'd be looking for.
Exactly, because what Elliott taught us was that, you know, the price structure that we see in larger markets represent the thought process of the public. And while we watch the structure tells us what the thought process of the public is. And we look for a specific structure to tell us the thought process has now moved into the bullish phase for the public.
That's fantastic. So now what we're going to do is switch back and now talk about this from the fundamental side. So Brian, back to you. And the question again was, what levels are you specifically seeing in terms of upside for the gold market? So where do you think we could be going, and what kind of time frame are you looking at, as well as that part B, if we can, for you, how will we know when this move has begun?
Well, I agree with Avi that we're in a bottoming formation right now, but I'm taking it from a different standpoint. I've looked at this market, and I think there's a fundamental difference in the market, in the gold market around 2000. So going back that far and looking since then at all the summertime declines or summertime periods that we've had in gold, typically what I've found is that the market bottoms somewhere between mid-July and mid-August. So it's kind of in that phase right now. That it varies a bit, can vary a bit. We could go a little longer. I think that I'm looking for the market to begin rebounding a bit earlier than Avi's looking at it from his technical analysis. But I think also, Avi, if it bottomed right now but started rallying within the next week or two, I think that would also fit within your parameters.
Absolutely.
If I'm not wrong there. So I'm looking at it at some point over the next few weeks to likely bottom if it fits past seasonal patterns that I've seen. And typically what we've seen is that these rallies off summertime bottoms have been on the order of 10% at least or better. And if we get that kind of a rally here, we're going to get back into that, that 1350 to 1375 level that we were bouncing against earlier this year and even late last year. A key level for me and for other people that are more rudimentary technical analysts and not using really Elliott Wave, but we're just looking at the 2016 high, which was about 1372. That's a level that gold since then has not been able to surpass, and that would be a key level. And if we get to that level, the momentum could well take us over 1400, in which case there's just a lot of air between there and the previous highs in the 1900 level. So there's just not much resistance that we see from that standpoint. In short, I think that coming off of the summertime bottom, if we have a 10 to 12% rally, we'll get back to those levels, those key resistance levels that we had earlier in the high 1300s. And it really depends on how much momentum we have at that point, whether we can finally burst through. But even so, that would be a very profitable move for people who get positioned around these levels.
Fantastic. So we're looking at it. We're in a period that we can oftentimes say, based on your research, that seasonality, this is more of a bottoming period. We look for generally about a 10% move off of that that, as you said, that midsummer pullback that you've seen in the past, that happens to coincide very nicely with what you consider to be a very key price region, which is that 2016 high right around 1372. So that's where it's lining up for you. The seasonality push gets us to that that key 2016 high level, and then for you, kind of knowing, do we have that momentum to really start to say that this is that longer term bottom? It would be then starting to begin to push through that level, and then of course the 1400 level, where you see a little bit more thinness in terms of then starting to head higher. Is that kind of a fair?
Yes, I think that's fair. And perhaps another factor that I should mention that I'm looking at is that the Fed is raising rates, and really raising rates as quickly as they can to try and get enough of a buffer zone between them and zero so that they can respond by cutting rates appropriately, at least 300 basis points in the event of the eventual recession or downturn in the economy. So they're really trying to get rates up as high as they can, but they're really bound both at the lower end and the top end at this point, because we can't afford the interest rate burden of higher rates or normalized rates. So really, over the next few decades, we're not going to see, unless there's some kind of a dramatic monetary reset, we can't see higher rates again because we simply can't afford them with the size of our debt being what it is at this point. So the Fed is really in the back half of its rate hike campaign. And Avi and I were talking earlier about his view that the Fed follows and really doesn't lead. And I agree to some extent that they're becoming a victim of these circumstances and will eventually lose control. I don't think they want to get over 3% on the Fed funds rate. I'm not sure they could get that high at this point before events really dictate that they have to begin easing again. So there aren't that many rate hikes left in this campaign, is the bottom line. They're in the back half of that campaign. And as we approach the end, and as the market and investors realize that they're approaching the end, they're going to start switching their bets and betting against the dollar and for gold, because they know that the next move is going to be lower.
I actually differ a bit from a quote unquote fundamental perspective with Brian on this one. What I foresee is more in line of a rising yield deflation once we top out in the market. I'm not expecting that I'm expecting a 20 to 30% correction to come out in the market starting in 2019. But I just see that as now setting us up for another rally that's going to take us to the final top, probably in the mid 2020s in the S&P 500 from a timing perspective. Mm-hmm. But once we hit that timing perspective where we're going to top, my expectation is for a rising yield deflation. In other words, my expectation is that asset prices will tumble, and I'm looking for a 10 to 20 year bear market to begin from that point. But at the same time, I'm looking for a rising yield. I'm looking for rising rates, similar to what Europe experienced during the Greek debt debacle. I believe that's probably, in my opinion, that's what I think the United States is in for during that 10 to 20 year bear market that I foresee. So I can easily see rising rates. I could see a rising dollar, and I can also see rising metals all along in the same path.
Now, Brian, I wanted to follow up on some of your comments here and ask you, in terms of now we start to see a move, what are some ways that you like to gauge or can tell if that move in gold is based on what you would consider to be strong long-term drivers? So again, kind of more the fundamental look at what can happen that keeps telling you, okay, this is how I want to see it play out, and this makes me even more confident in this move.
Well, gold is the ultimate currency. It's the barometer of the health of, well, it's the ultimate money, and it is the barometer of the health of the attendant fiat currency or global reserve currency. So really it runs counter to that. In any sustained move in gold, has to be based on monetary concerns or monetary issues. In short, it has to be based on the either ongoing depreciation of fiat currencies or the anticipation of that depreciation. So when you see mainstream market analysts talk about geopolitical concerns and worries and how they are wondering why gold isn't responding, or commenting that gold is responding to some geopolitical dust up somewhere in the world, that's no reason for anyone to invest in gold, in my view. In fact, if you try to invest in gold based on one of these little firestorms that occur here and there, you're going to end up being a loser, because you're never going to be the first one in, and you're certainly not going to be the first one out. So you're going to end up, with the vast majority of investors will end up holding the bag on those kinds of moves. And they are short term. The sun generally comes up tomorrow. These things typically work out, and they eventually work out at some point. So these are all short-term moves, and fundamentally and logically, there's no reason to buy gold on a global basis due to any of these little geopolitical issues. On a short-term or on a very localized basis, if you're in the middle of one of these particular crises, you probably do want to own gold. But it's no reason for globally gold prices to go up. So what I look for is gold going up, or is a move higher in gold based on some fundamental worries about money and currencies and or inflation? And one way to tell that is silver offering leverage to that move. You can look at it on a daily basis. If silver rises more on a percentage basis than gold that day, that's a good sign. That's a sign of a classical gold bull market. If the mining stocks are also offering leverage, that's an additional sign or indicator of a classical bull market situation. So I like it when both of those, when both mining stocks and silver are rising more than gold. I think that's a key sign that gold's going up for the right reasons.
Oh, that's a very interesting take. Thank you so much for that. So, Brian, we're going to stick with you here, and now we're going to say that gold, as much as we may want it to, everything doesn't always go up the way we want it to, how we want it to, at the time frame we want it to, and it is prudent to look at the risk reward. So, what I'd like to ask you now is, how does the downside risk in gold, and also silver, if you like to follow that as well, now compare to the upside potential? What do you see as the risk reward here for people that are maybe just starting to consider positions?
Well, let's start off from the fundamental, from the standpoint that we're in a bottoming process. And if you accept that proposition, then you have to look at the downside being limited probably for gold to around 5%, for silver maybe perhaps 10%. But the downside in the metal itself is probably 5%. Now in Gold Newsletter, we focus on the junior mining sector as a way to not only leverage the moves in the metals, but also focus on the ability of us to do some research in these companies in a very inefficient market and try and find advantages where a company can advance on exploration success or misvaluation of what it's already found in terms of mineral resources. But the key here is that these stocks offer extreme leverage to gold, both on the upside and the downside. If gold has a downside risk of perhaps 5%, if it has, on the other hand, an upside potential in the fairly near term of 10% in this kind of late summertime rally, what we would do, or we would see in some of these junior mining stocks that especially the ones we cover in Gold Newsletter, and especially the ones that have large identified gold and silver resources, we would see them probably go up 100% or more on a 10% move in gold from these levels. So that's a kind of risk-reward dynamic that has me screaming from the rooftops right now to my readers and at conferences I go to, that you don't have much downside risk at these levels, but the upside risk, if things If the markets perform according to past patterns, which is very likely in this case, the upside potential is over 100% in some of these really quality junior resource stocks.
Thank you very much. So Avi, same question. What are you looking at as the downside risk in gold? And obviously we've maybe because we have obviously we've talked about the 50-year time frame. Maybe even we'll drill, if you can, drill it down a little bit further of more shorter term. If someone's looking at getting in now, what's their risk reward based on what you're seeing?
Well, I mean, I pretty much agree with what Brian said, but I can foresee. You know, I see a 20 to maybe 30% chance you could see as much as a 7 or 8% decline from here. I don't see it as a high percentage chance, but it still exists that we could drop as deep as 7 or 8% from here. But you know, the way I would put it, you know, you could maybe see 7 or 8% lower. I don't think it goes that deep, but there's a possibility. But the other side is, you know, if we begin the rally that I expect, you probably will not probably, you most likely will not see the levels that you're able to buy it at right now for the rest of your lifetime. So I think, you know, you can talk about, you know, a year from now, you could talk about 2 years from now, you could talk about 50 years from now. You know, what I'm saying is if the structure holds within the next 7%, then these are levels you likely will not see again in your lifetime.
That is very powerful, something to remember. So we've got the downside potential risk. We've got the upside as you guys see it. So if, and Avi, will stick with you here, if gold does move as expected, how can an investor leverage those gains? Or in other words, what are the ways that you see participating in the rally? What are the best ways that you see to participate in this gold rally?
I think Brian hit the nail on the head when he said silver and mining stocks. There's no question about it. Those are both very leveraged ways of playing the next big move in the market. But one thing I have stressed repeatedly over this last 2-year consolidation in the overall complex is, and I cannot stress this enough, I've seen too many people hurt themselves by trying to jump the gun and get into 3 times ETFs, you know, the leverage ETFs and options. I've been harping over and over and over again to all my subscribers, stay away from leverage until we have the confirmed breakout. Once we get the confirmed breakout, there will be plenty of money to be made using options, using 3 times leveraged products. Until we get that confirmed breakout, stay away from that type of leverage. You want to buy individual mining stocks that are solid. You know, I'm not talking about some of the penny ones. I'm talking about some really good, solid miners to prepare. That's great. But stay away from the high risk stuff until we actually get a solid breakout signal.
And maybe just to follow up on that with you, Avi, I know for a lot of people out there, the GLD is a very easy product to use to get into the gold market and to trade in the gold market. And I know you have some feelings about the GLD. So I thought if you had a chance that maybe you'd take a little bit of time to share those with those that are here with us this evening.
Well, as you know, Tom, we did a very detailed, I'm an attorney and an accountant by training. And that's what I did in my former life. And I took apart the prospectus of the GLD. And we went through that in a webinar. Tom, I don't know if we can put it out for everybody to go see. But we went through the GLD prospectus in great detail and outlined why anybody who is interested in this complex for the long term should avoid the GLD like the plague. I would suggest you completely avoid the GLD with any of your long-term money. If you want to use it as a short-term trading vehicle, that is fine. But you have to understand the risks even if you do that. the GLD is not as solid as most people would believe, and that's for the general retail investor. I'm not talking about the big houses, which can probably get their money out. I'm talking about the general retail investor. I think you really need to have a better understanding of the prospectus and the risks involved in the GLD before you start putting in your long-term money in the GLD. And I think, Tom, I think we can put out the that webinar that we've done a while ago on it so people can actually see what's really in that prospectus.
Absolutely. We'll follow up with an email with everybody, and we'll make sure to include that so you guys can all take advantage of that recording, because we do have that available still. So switching over to you, Brian, if gold moves as expected, and you've touched upon this, I think, a little bit in your other answer, but how do you see best taking advantage of these, and what are some suggestions that you would have for people looking to play this upcoming rally?
That's exactly it. I kind of stole my own thunder there, but really there are a number of mining stocks, there are a number of junior mining stocks, not necessarily the exploration stocks, but the ones that already have proven very large gold and or silver resources. There are a number of them out there that we follow in Gold Newsletter that they really have two ways to rise or to pay off. One is with rising metal prices. As I said, if gold goes up 10%, I mean, we saw this in early 2016. We saw this in early 2017 on these 10% rallies in gold. And in 2016, of course, it was more like 20% rally in gold. These companies went up. They didn't just go up 100%. They went up 200, 300, 400% in price. And we can see that again. But on a 10% move higher in gold, I'm fairly confident that a number of these companies, and there's about 4 or 5 of them that are easy for most people to figure out. They have large multi-million ounce resources, and they are near the top on the list of takeover targets from the majors. And that's the other way that they can generate profits or big gains, is if they get taken over. In Gold Newsletter, we've been following Northern Empire, a play in Nevada, exploration development play, since November, and that just got bought out, or is getting bought out by Core Mining, and that's a 70% gain for our readers on that one pick since November. We're going to get much better than that if we get the kind of move we're expecting in gold. That's actually a fairly small gain or winner for our readers, and I'm expecting much better.
Fantastic. So we're moving on. We're going to stay here with you, Brian. What do you recommend if an investor wants to own physical bullion? So they don't want to maybe go with a vehicle like the GLD. They actually want to have that physical bullion. Is there any suggestions that you have?
Well, yeah, and speaking about GLD, I completely agree with Avi. I look at it as a trading vehicle. If you want to own physical metals for the long term, you really need to own physical metals. And I look at it as insurance for your wealth. There has to be a fundamental or a very basic foundational holding of physical metals in your portfolio if you have any degree of significant wealth accumulated. And there are a lot of ways to do that. There's more than we could possibly cover in this presentation. But what I advise people to do is diversify where you have these physical metals. Some people look at overseas storage. Some people look at domestic storage. Some people look at nearby security centers or vault storage. Some people have some in vaults and safes in their homes. My advice is, if you want a really safe way to store metals, diversify and use all of the above. Don't put it all in anyone's hands. I have a lot of close friends that are actually in the bullion industry, in the storage aspect of that industry, and people that I trust implicitly, but I don't trust all of their employees. Anything can happen. So I don't recommend any specific storage facility for anyone. I say you really just need to spread it around and spread the risk around. That said, in the bullion area, I strongly advise silver, and I strongly advise these old U.S. silver coins, commonly called bag silver or even junk silver by numismatists. They're bulky, they're dirty, but they're also small denomination and very low cost. Sometimes and quite often and usually they're the lowest cost way to buy physical bullion. And they have the advantage of being recognized, easily recognizable, widely valued, and in small denominations. So if you ever need to use them in a pinch, use it as actual currency in a pinch, you can use it to whatever degree you want. You know, if there is a major financial crisis, it's going to be very difficult to buy a loaf of bread with an ounce of gold and expect any change. But if you have these small denomination silver coins, you have the options of being able to use them as currency in any kind of an extreme situation. So that's really my top bullion recommendation.
That's some great advice. And Avi, we're going to switch now over to you. If someone's looking to own physical bullion, what are some of your suggestions?
I completely agree with what Brian just said. Just want to add a couple of things. One, you can also look at rounds. There have been times where I've been able to pick up rounds at lower premiums than the junk silver. Sometimes junk silver is hard to get, believe it or not. So I've actually gone through periods where I've amassed a bunch of just regular rounds as well, silver rounds. The other thing that I want to touch upon is a little bit of history. Back when gold was confiscated by the federal government, there was an exclusion to that confiscation for those coins that had independent numismatic value attached to those coins in addition to their gold value. So if you choose to leave any gold in the United States for storage, that may be an option to consider. Because, you know, I'm not saying that we certainly will see another confiscation event, you know, but history doesn't always repeat exactly the same way, but it often rhymes. So if you're buying gold to protect yourself during that type of event, you want to be able to hold on to that gold rather than have somebody force a confiscation on you. So you want to take as many precautions as possible. And from what I saw recently, the premiums on those, and for example, the St. Gaudens or things like that, you know, the premium on those type of those coins that have numismatic value are really at the lowest I've seen in a very long time. So if you're looking to buy more gold now, I would strongly consider those type of coins, especially if you intend to leave it in this country for storage.
And Tom, I would absolutely agree with that, and I should have mentioned that as well. These low value, I mean, if you get into really high-end numismatic coins, you really need to educate yourself and pursue it as a hobby as much as anything else. But these lower grade semi-numismatic old U.S. gold coins are absolutely a wonderful way to build up bullion. The premiums are near historic lows. So these are things that are about uncirculated or even higher grade circulated coins. Those are very affordable right now and a very good way to buy bullion because they were protected in the last U.S. gold confiscation.
That's fantastic information. Jotting down my notes as we go through it just as well as probably everybody else at home. So that was kind of the end of the discussion, the questions that we had come into tonight, at least wanting to prepare and to give people a flavor of both of your analysis styles and as well as maybe most importantly where we saw the markets going. Avi, I'll stick with you since we left off with you at question 5. I just want to give you the opportunity to say if there was anything that I didn't ask, or if there, a topic that we weren't able to get to, but you did want to make sure that you left people with some type of impression tonight, something that's important to you. I just want to open up this period for you to kind of get that in.
Well, while I do recognize, where the fundamentals reside in this market, I understand the fundamental perspective. I do strongly suggest people consider the sentiment side of the market, because personally I believe the sentiment side is what drives not only price, but I also believe sentiment drives the fundamentals. You know, how people feel is going to cause how they react. And it's not the other way around. People's reaction do not cause how people feel. You react based upon how you feel. And so, you know, we can put out an article I put out a while ago as to why sentiment is the primary driver of not just price, but also fundamentals. So if you want to understand the fundamentals even better in the market, you really want to have a better understanding of the overall sentiment perspective in the market, and you'll understand both price and fundamentals by understanding how sentiment drives the overall market as a whole.
Yes, and I just put that link. We didn't really get to touch upon this article as much as I think we thought we might, but I did just put a link to that article in the chat box to everyone, so hopefully you have that. And I'll see that we can make sure that we also include a link to this in the follow-up email along with that GLD webinar that we previously mentioned. So Brian, same question. You know, this was a great talk. We got to cover a lot of things, but if we could maybe get your insights on anything we didn't touch upon, or something that you just want to make sure that you leave with everybody knowing tonight about your stance in the metals market and what you're seeing, I'd really appreciate it.
Absolutely. And I guess the one thing I neglected to speak about was that chart I sent you, which shows the commitment of traders reports. The CFTC puts out these commitment of traders reports every Friday, and they cover the positions up to the preceding Tuesday of various categories of traders on the COMEX. And they disaggregate these into various categories. But broadly speaking, there's the large speculators, which are essentially managed money. And then there are the large commercials, which are groups that typically have to buy gold to hedge their business operations, or bullion banks acting on behalf of clients who have to hedge gold for their bullion operations. And those categories have gotten kind of blurred over the years, but generally speaking, you can see that the managed money positions, which is what this chart shows, are typically get the direction of the market wrong, or at least at big turning points. And I noticed that the chart's a bit small, but on the upper panel, if you see that single line, that shows the net positioning of the managed money. And they've generally gone from wild extremes to wildly bullish, or largely long to less bullish, but rarely net short. 2 times in the history of this report, going back to 2006, they've actually been net short, one of them being in early 2016. And we know what happened then. We bottomed right at the end of December, mid-December of 2015, and took off on about a 20% run right off the bat in gold. And as I said before, a number of these mining stocks went up 3, 4, 5 times in value on that run. That was the last time these managed money speculators were net short gold, and they were net short about 24,000 contracts at that point in time. Today, as you can see by that line, they're net short again, but now to the tune of about 43,000 contracts. So they've never been net short to this degree. They've rarely been net short at all. But whenever their aggregator to net positions have been very low, it signaled a major turn in the market. So from that basis alone, there's a very significant indication that we're near a bottom in the gold market and due for a major rally.
And I completely agree with Brian. And when we finally get that ignition, all those shorts are going, all that short covering is going to be major fuel for that rally.
Exactly.
This is fantastic. So we've kind of come to a close of at least what we wanted to get out to you today. So we wanted to give you that opportunity We are very fortunate to have an extremely large audience tonight, and we're happy that all of you came here. But we would like to try to get to as many questions as we can for both Brian and Avi. So if you did have any questions that you wanted to get to, I'm sure I'm going to try to look up through the list here and see if we can get to any. I think, Avi, you're now also maybe scanning through these. So if you did see one that you thought was something that you wanted to make sure that you got to. I know a lot of these questions have, it looks like as I'm looking back, a lot of them got answered as we went through. If any of you did have a question, we're going to keep it on gold and silver. Also, we can do the miners since we've opened that up as well. We won't start to bring in other
a number of the questions about other topics. So let's try to stay on topic here, folks.
Right, but we do want to give you this. And if you've asked your question earlier, I do apologize because of the mic check and some other questions that came through that did get answered. If you wouldn't mind just go ahead and repeating that, putting it back in the box again, that would be very helpful to us. So, okay, we're going to do it. We're going to do it, Avi. I know.
Oh, no.
Nope, we're doing it. So,
oh, no.
Gentlemen, and I'll start with you, Avi, because I know you love it. Could you please tell me about manipulation in the gold and silver market?
Okay. I have written extensively on this, and Gold Eagle even approached me to write a whole piece of their ebook on this topic. Most people that have read me think that I deny that there is manipulation in the market. That is not true. There is definitely, and I'm going to put it in quotes, manipulation in the market, but such manipulation is not what most have come to believe as the type of manipulation that has taken gold down from, or taken silver down from $50 to $14. Silver was not manipulated to drop from $50 to $14. That was a traditional market correction. That is not manipulation. However, the type of manipulation that you do see in the market, and that you're seeing a lot of the cases coming out about various houses being hit by fines, with fines for manipulation, is, where they're trying to do what we call spoofing, or they're trying to garner pennies on bid asks. That's really the type of manipulation we see in the market today, and that's what all the fines are about. So if you actually go back and read the cases that have come up where the fines have been imposed, that's really what we're talking about. We're talking about very small degree manipulations. And not only that, but those manipulations have occurred in both directions. Let me repeat that again. Those manipulations have occurred in both directions. So if anybody attempts to tell you that the market has been manipulated to drop from $50 in silver to $14 in silver, all they're saying to you is, the only way this market is supposed to react is to go up. That's not true. Markets progress, markets regress. It is just the natural course of markets. And clearly those people did not see this correction coming. If you understood that this correction was setting up like we did back in 2011, none of this was a surprise. There was no manipulation here. People that were caught, looking higher as the market was topping, well, you know what? Manipulation is a great scapegoat. But when you come down to the actual facts of what is going on in the market and what all these cases that are coming up with all these fines that are being imposed, none of it presents any type of evidence that silver was caused to drop from 50 to 14. Rather, it's almost like saying, a paper cut caused the market to bleed to death. That's absurd. And that's pretty much the same thing when it comes to manipulation in the market. Manipulation is not taking the market from $50 silver to 14. Is there manipulation in the market? Yes, but it's very small degrees, and that's what you're seeing fines on. So that's my general perspective of manipulation. Many people can choose to disagree with me, but I've actually done the homework. I've looked at the case law. I've looked at all the pleadings on this. I've done my homework on this. That's really what's going on from my perspective.
Brian, manipulation in the metals market. What are your feelings about it?
Oh, wow, Tom. I could go on for an entire webinar on this. My opinion on this is much more complex. I guess, is the government manipulating, has the government manipulated the gold price? Well, yes, obviously they have. There have been a number of overt and covert instances. I mean, putting aside the confiscation and devaluation of the dollar confiscation of gold and devaluation of the dollar a few months later in 1933, you have the London gold pool in 1960s, you have the Treasury gold auctions in the 1970s. So the government has manipulated or tried to manipulate the gold price primarily when the dollar has been connected to gold, which leads to the larger issue that, the government or the Federal Reserve manipulates every other market. They have a put under the stock market or have had one to some degree for some time. And of course, they manipulate interest rates, which is the price of money, which is the price of everything. So at some level, they manipulate markets. I'm not a believer, as many of my friends in the gold manipulation community are, that government actually actively manipulates the gold price on a daily basis. I just don't believe that government is that capable or even that interested in gold to do something like that on a daily basis. I do feel the structure of the paper gold market allows institutions to move the market to some degree. I agree with Avi that not to the degree that you're going from $50 to $14 on the silver price, but at certain times they can manipulate it. And that kind of leverage in the paper gold market really divorces that supposed asset from any physical market supply and demand influences. Also, in addition to the spoofing that Avi was talking about, I think high frequency trading is something that's become more and more prevalent and important and impactful in the gold and silver markets, particularly the gold market. The gold market is kind of a Goldilocks market, if you will. It's not too big and not too small. A high frequency trader who can bring $100 to $150 million to bear in the market over the span of a few minutes can pocket perhaps $1 billion if they do it correctly and have done it correctly. I'm a big fan of the Eric Hunsader at Nanex that tracks not just gold but really every market on a tick by tick basis, and has a data analysis firm that has been able to go through and analyze the patterns, the fingerprints that these high frequency traders have taken in these markets where, they've driven the gold price down $20 in a matter of a few minutes by dumping shorts on the market and then covering at the bottom and catching it, profiting on the way back up. So it's a complicated story. In other words, I do believe the structure of the market allows for some games to be played. I do think that the government at some times in history will look at key points in the market and try and move it one way or the other so they don't look bad or they influence actions. But that's largely behind us, at least on a big, on a major basis. I do think that there are institutions that are using the leverage in the paper gold market to play games in the sector. But eventually, that's going to work out toward to the bull's advantage because a market that's held lower will recoil much more to a greater degree to get back to equilibrium.
Oh, that's a fantastic discussion, guys. I think because I know that's a topic that people ask us a lot.
I want to address the Fed issue, and I know that people have come to me with this so many times. GATA publishes these things so often, and so I've looked at all the proof that people cite about the Fed, and what I've come to conclude after looking at all the detail is that a lot of it is based upon taking some of these quotes out of context. One of them, I just pulled up an article that I wrote, and this is actually the article for Gold Eagle, which was entitled, "Was the Metals Market Manipulated to Drop from 2011 to 2015?" One of the things I addressed was the Fed. And let me pull it up. There was one quote that Gata and their ilk always focus upon. And it's what Greenspan said in before the Committee on Banking and Financial Services in 1998 that, and here's the quote, "Central banks stand ready to lease gold in increasing quantities should the price rise." And everybody gloms onto that to say the Fed absolutely is manipulating gold. Now, if you actually took the rest of his presentation and actually put that into context, you would realize that he wasn't saying that the Fed is manipulating gold. In fact, what he was saying is that he was giving that the Fed may have a tool to combat somebody else's manipulation attempt. And that is a tool that he was presenting where they may be able to combat somebody else's manipulation attempts. He's never even opined as to whether or not such a tool would or could even be successful. But the real kicker was what he said right after that. And I'm going to quote, "Even with centralized execution or clearing, the most relevant attributes of these markets would not represent those of agricultural futures markets, and hence would not be susceptible to manipulation." Nobody quotes that Greenspan ever said that. So, there's a lot of misinformation about what the Fed does and what the Fed doesn't do. And, there's a lot of illusion into what the Fed may do or what the Fed may not do. But, when you actually take apart what a lot of these people actually say, rather than take a lot of the quotes that are put out there from for misinformation purposes to some extent, and I think Gata is the worst of all the people that do this. They really strike fear in people, and that's what their entire perspective is based upon, which is why I really disagree with their perspective. If you really take a look at what these people actually say within context, it's not exactly what is being presented out there to the masses.
No, again, I really appreciate you both of you addressing this, because I do see this as a common question from people that are currently have gold positions, have physical gold, as well as people that are looking to get into the market, and they say, I don't want to get into this market if I'm going to be a salmon swimming upstream with the bears all the way around it with this manipulation. So I really appreciate you both going into that in more detail and kind of the history of it and how you see it playing out, as well as that the long-term investor, even if there are these cases of manipulation, can overcome. So,
and Tom, I would have to say as well that I know a lot of those guys in Gata, and actually they actually got their start through some research that we did with or published Frank Veneroso's back in the late 1990s, and I think those guys provide actually a lot of good research on the market. I do is they disagree in a number of areas with them, and frankly I agree with them in a number of other ways. But I think that they also agree that when at some point the gold market is going to be headed much higher. In fact, that if there is some level of manipulation in the market, at some point it has to end or it will end, and that it's not necessarily a negative for people who want to invest in gold because of the trends they see either from a technical or fundamental basis. It's not a reason not to invest in gold, in other words.
I do just want to throw in one, because we've gotten a bunch of questions about if this is being recorded, and it definitely is, and we'll also get this copy of this out to you. We know we're covering a lot of information here, and there's been some levels discussed. So if you didn't have a chance to take some notes, or you just want to use this to play back, we'll definitely be providing that to you. So we've talked a little bit about maybe at least some concerns about the GLD, using that vehicle as a very long-term investing vehicle. At least you have to go into that with eyes wide open. There are some questions about individual stocks. I think both the gold newsletter that Brian is editor of, which it's on your screen right now, and then also Avi at Elliott Wave Trader, there are services that they offer analysis and insights on specific individual stocks. And Brian was talking about some of the baskets of stocks that they'll outline for their readers. But so someone is writing in with they have a 401k where they can't purchase individual stocks, but they do see that there's maybe the option for some forms of metals funds that are they do have access to. Is there any type of mutual fund or ETF that either of you have come across? And we'll start with Brian. That is at least one that you've maybe heard good things of, used yourself, or happen to know about that you would consider to be a recommendation for somebody that at least has a situation that they can't purchase a stock or physical in their account.
Yeah, there's the typical ones like GDX and GDXJ. And I have to apologize because Sprott has one that does a unique way of rebalancing and rating gold producers. And I can't remember which one it is, but Sprott does have a good offering in the sector that actually works to try and find the better or faster growing gold miners, as opposed to the just an index based on market cap.
Thank you very much. And Avi, any funds that, again, that she may not have access to them, but any funds that you've come across for somebody that can't trade the individual stocks, even the ETFs that we've already kind of highlighted, that they might be able to take advantage of?
From what I understand, as Brian put it, Sprott, I think, does have the metals in storage that they represent. They do in their funds. But no matter what fund you choose, I would be poring over that prospectus with a fine-tooth comb to see where there's wiggle room for anybody who's running that fund to not have that those physical metals on hand that they represent they have on hand. That, in a nutshell, that's the problem with the GLD. So that's in a very, very simple nutshell, that's the problem with the GLD. So I would be going over any prospectus with a fine-tooth comb if you're looking to invest in an ETF for a long-term hold on metals.
And Brian, I just wanted to kick it back to you because in going over your site, I happen to see and as I mentioned at the beginning, you being the CEO of the New Orleans Investment Conference. Is that conference coming up here in the next few months?
Absolutely. It's November 1st through the 4th here in New Orleans. And it's, this is our 44th year, so we've been around a while. And we've had tremendous speakers and really giants of recent history in geopolitics, economics, and various sectors. And we do have a long-standing dedication or legacy in gold and mining stocks, as well as free market economics. This year, our speakers are Robert Kiyosaki, Mark Stein, Jonah Goldberg, James Grant, Doug Casey, Rick Rule, Peter Schiff, Dennis Gartman, Guy Adami, and it goes on, frankly. And next year, although Avi isn't speaking this year, I'd love to get him here down there next year. There's so much respect for youth and analysis. And of course, we'll be well into the gold bull market by then, so we'll have a lot to talk about. But yeah, it's November 1st through the 4th, and listeners can go to neworleansconference.com, get all of the details. It's kind of a one-stop shop to find really the hottest strategies, the hottest picks, but also the most well thought out strategies and predictions of the top experts in every area.
That's fantastic. So I know we actually went a little bit over the hour. Hopefully no one minded. I know I didn't. And just want to, on behalf of everybody that took the time this evening to stop in and try to gain some knowledge from you guys, both Brian and Avi, really just want to thank you so much for taking time. We all know that you both have very busy schedules, but we appreciate you taking the time to try to just give us some of your expertise, share that with us so that hopefully it helps benefit us in our metals investing and trading. So we really just wanted to thank you again for both of you being here. And of course, on behalf of Avi and Brian, the few hundred people that took the time to show up and spend your evening with us, we just can't thank you enough, and we hope that you benefited and take away something from this presentation. So to you gentlemen and to everybody that came in, thank you very much, and I hope all of you have a great evening.